When Warren Buffett looks at whether to buy or pass on a stock, he has four fundamental principles, which he assesses the stock's quality on. From here, he can quickly determine if a stock is worth buying or not. By strictly abiding to these four rules, which are mostly reliant on numbers rather than emotions, Warren Buffett has built one of the most successful businesses in history. So what is Warren Buffett's first rule when looking at a stock? He asks himself, is the company well managed? By this, he is not referring to the people in charge, although he will later meet with the company's management to assess them, but that is for another day. If a company is well managed refers to how well a company manages debt. This can be checked by two simple ratios, the debt to equity ratio and the current ratio. Through these ratios, Warren can see if a company can deal with its debt and in the long term if it is a safe investment. High levels of debt would imply a company has a higher risk associated and it may not be an adequate purchase. Firstly, we will check a company's debt to equity ratio. In order to find this, we will go to msnmoney.com. For this example, I will use Apple, as it is Berkshire Hathaway's current highest holding. From MSN Money, we enter the company's ticker. Click on the Financial tab and then the balance sheet. To find our debt, we add all the columns which have debt in their title. This will give us how much a company owes. However, another way to populate the debt field into our ratio is to use the total liabilities column. This can be used if you are highly conservative, as it will give you a much higher debt. For equity, we simply use the figure given as total equity at the bottom of the balance sheet. Now, what does Warren Buffett look for in this ratio? Ideally, he wants to see less than 0.5 debt to equity ratio. This number is something to take note of for the future, as it is important. As we can see from Apple's balance sheet, total equity stands at this figure. Now we will check the total debt. This will equate to all the figures with debt in their title. So current debt plus long-term debt is our debt figure. Now we divide our total debt by our equity. Personally, I use this way to calculate the debt to equity ratio rather than using total liabilities, as by using total liabilities, the debt to equity ratio will be much further off. Anyway, we can see that our debt to equity ratio is 0.18, which is much less than the 0.5 which Warren Buffett looks for. Warren Buffett approves. Next is the current ratio. This is a ratio of how a company will fare with debt in the next 12 months by comparing current assets to current liabilities. For Buffett, he likes to have this at greater than 1.5. Once again, we go to MSN Money, click on the Analysis tab and Price Ratios. From here, we can see the current ratio. For Apple, this is a healthy 1.60. Once again, another tick on the Warren Buffett checklist, as it is over 1.5. That is all for the first part of Warren Buffett's rules to buying companies. Please stay tuned for part 2 of 4. Please like and subscribe and leave a comment with any questions you may have.